So what happens when you take a high-flying, headline-grabbing tech stock and pit it against a boring old industrial giant? We're going to run them both through Warren Buffett's legendary investment gauntlet. We'll apply his time-tested framework to these two radically different companies and see which one, if any, is left standing. Here's how we're going to break it all down. First, we'll get the rules of the game, what Buffett's gauntlet actually is. Then, we'll put both companies through four crucial trials: the moat, the management, the financials, and the all-important price test. And only then will we get to the final verdict. All right, first things first, let's set the stage. The Buffett framework, it's not about complicated math or trying to predict the next hot trend. Nope. It's a super disciplined business-first approach that's built on four core pillars. And here they are. It all starts with a rule that sounds almost too simple. You have to understand the business. Then, you need to find one with what he famously calls a moat, a durable competitive advantage. Of course, a great business with bad pilots is a disaster, so you need able and trustworthy management. And finally, the step that saves your skin. You have to buy it at an attractive price. This isn't just a casual checklist. For Buffett, you have to clear every single one of these hurdles. So, let's meet our contenders. In this corner, we've got the challenger, Carvana, the online used car dealer with those wild car vending machines. It's a high-growth, high-risk tech story. And in the other corner, the champion, CRH PLC. They're a global giant in building materials. We're talking cement, asphalt, the stuff that builds our world. So, yeah, a tech disruptor versus an old-school industrial behemoth. Let's get right to it with our first and, honestly, maybe the most important test, the business moat. Is there anything protecting this company from the competition? Something that lets it rake in high profits year after year? Wow, okay, the contrast here is just immediate and striking. Carvana is in a brutal, hyper-competitive market. Selling used cars is basically a commodity business, which means they have zero pricing power. CRH, though? Totally different story. They have a massive moat built on sheer scale and logistics. I mean, think about it. You can't just open a new quarry wherever you want. And the cost to haul around tons of gravel and cement is insane. This creates these little local monopolies and gives them real pricing power that can keep up with inflation. All right, next up, management. Buffett always says you want to be in business with people you trust. So let's pull up the report card for the folks running these two companies. Are they any good? And again, this slide tells a very clear story. When you look into Carvana's management, you find some serious red flags, from past allegations to insiders dumping huge amounts of stock right at the peak, and their decisions with company money have frankly destroyed shareholder value. On the flip side, CRH's management has this long, steady track record of smart acquisitions and consistently giving cash back to its shareholders. It's night and day. Okay, time to pop the hood and look at the engine. Do the numbers actually back up the story? This is where the quality of a business, or lack thereof, really shines through. The numbers here are just stark. Carvana has consistently lost money. Its return on equity is negative. That means for every dollar an investor has in the business, it's actually losing a piece of it. It's also burning through cash like crazy. CRH, meanwhile, is a financial fortress. It generates a really solid 15% return on equity, and, more importantly, it spits out billions in actual, spendable cash profit every single year. And to really put a fine point on Carvana's situation, just look at this number. That's over $6 billion in net debt. For a company that isn't making any money, that is a terrifyingly heavy anchor to be dragging around. So we've pretty much established that one of these companies is much higher quality than the other. But, and this is a huge but, even the best company in the world can be a horrible investment if you overpay. This brings us to the final test, valuation and what Buffett calls the margin of safety. So what on earth is a margin of safety? Well, it's the absolute cornerstone of Buffett's entire philosophy. It just means buying something for way less than you think it's actually worth. That discount is your buffer. It's your protection in case you're wrong or in case some bad luck comes along. And when we apply this test, we find a problem with both companies, just for different reasons. Carvana offers no margin of safety because its price is based on pure speculation. It's a bet on some far-off dream, not today's reality. Then you have CRH, which is the opposite problem. It's a wonderful company, but the market knows it, so it's trading at a fair price. And a fair price leaves you almost no room for error.
Okay, we've put both companies through the ringer. We've tested their business, their management, their financials, and their price. We've reached the end of the gauntlet, so what's the final word from this analysis?
Look, for Carvana, it's not even a close call. The conclusion is crystal clear. It fails on almost every single one of Buffett's principles. It has no moat, the financials are a mess, and the valuation is just pure risk. From a value investing standpoint, it's pretty much the exact opposite of what you'd want to own. Now, for CRH, the verdict is way more nuanced. This is a high quality, moat protected, well run business. It passes the first three tests with flying colors, but it stumbles at that final hurdle price. It's a wonderful company, but it's not a wonderful buy at its current valuation. The smart play here? Put it on your watch list and wait patiently for a better price. This whole exercise really just shows you the power of having a disciplined framework, right? It cuts through all the market noise and the hype and forces you to focus on what actually matters for long-term success. And it leaves us with one final and, I think, really important question to ask ourselves. If you were to run your own investments through this same four-step gauntlet, how many of them would actually pass?